Well, actually, the first time I wrote about this was in for a little site before my blog in 2005, and so at the time, really, I was thinking about the age-old problem of the Austrian theory of money, which is really first elucidated by Karl Menger, which is the question of why certain kinds of goods seem to have anomalous value. People, of course, often focus on the material utility of the classic, sort of pre-modern monetary standards of precious metals, and they're like, "Ooh, it's valuable," but in fact, these goods are grossly overvalued, considering their. If you analyze them as simply as commodities, they don't make sense. You see an enormous stock of these commodities, and that stock keeps being accumulated instead of drawn down, and the price is wildly disproportionate to the demand for industrial use of these goods. So there's obviously something sort of interesting going on here, and the simplest way to think about it is that money is essentially a store of value. It's a medium of savings. It's a way that you move purchasing power from the present into the future. Even the presence of financial instruments like bonds don't really change the need to physically shift purchasing power from the present to the future. Even if you lend money to be returned in the future, you're lending it to someone who therefore is holding money. So lending abstractly should not change the demand for money. So there's always a demand for some such good. And when you look at the sort of game theory of the demand for this good, which is sort of uses some concepts that the classical Austrians didn't really have at hand, you see that you're basically looking at a coordination problem, because you have to standardize on some store of value which is going to be overvalued, and so you have at least one good that has to be overvalued in an economy. But if you have more than one, that's an unstable competition. Whereas to have exactly one, and there can be only one, as they used to say in the movie Highlander, a great 80s movie. So the stable state of the system, just very, very abstractly, is a state in which there is one dominant money. And so what happens when that standard is created, or when standards change, which is a very, sort of cataclysmic financial event. This, of course, is the Bitcoin hypermonetization, Bitcoin maximalism, essentially theory. What happens when one of these standards is created is basically people move their savings into this good. And if this good is an appropriate money, appreciating its price will not substantially appreciate its supply, which is obviously very important. And violated a little bit in the case of the precious metals. I mean, when the gold price goes up, it increases gold mining a little bit, but the amount of newly mined gold is still quite small compared to the world gold stock. And so what will happen is that basically people will buy this good up in sort of exactly the same way as GameStop stock was bought up last year. And so when something goes up because everyone is buying in, and not because it has any intrinsic value or utility, that looks like a bubble. It's in fact the same thing as a bubble. And so when we look at sort of a financial bubble, we can see sort of an attempt to re-standardize a money. And that attempt is sort of, if the bubble pops, and there are various ways that certainly Bitcoin could, in theory, pop. If the bubble pops, it looks like this ridiculous tulip scam all over again. If it goes to completion, it looks like, you bought into, this incredible thing, very early. And so, the general cause for sort of an intrinsic demand to re-standardize money today is basically monetary dilution. And when I say monetary dilution, most people will sort of define the stock of money in dollars using very narrow instruments like M0, M1. I prefer to basically describe the stock of dollars as the total net worth in dollars of all people holding dollars and dollar denominated financial instruments and financed assets. And that's essentially defining the dollar supply as the sum of personal net worth, which is a statistic, I don't know how accurate it is. It's a statistic that, the Fed keeps. And so when you see personal net worth, I think in like 2021, it may have gone up by, or 2020 to 21, it was going up by $20 trillion a year. This is obviously not the stuff that we have is getting $20 trillion more valuable. Maybe we have wine and the wine is aging. I don't think that's how it's working. It's basically a sort of this way of creating dollars. Broadly stated, when the stock market goes up, everyone feels good. It is no different from printing money and sending it primarily to rich people. And so what you're doing, you're actually running this very cynical economy that's doing two things. One is that it's running on the basis of printing money and sending it to rich people. Another way to see that is that the economy is actually losing $20 trillion a year because those are liabilities. Your stock, when the stock market goes up, you're creating liabilities. Equity is a liability on a balance sheet. And so, when basically the total financed value of this financial asset is increasing, what you're seeing is that basically $20 trillion got created out of thin air. Basically, $20 trillion got borrowed out of thin air because those companies now have to justify, in theory, those valuations. So in practice, you're looking at this very strange system where if you set interest rates to basically zero, which is a very strange thing to do, not least because the valuation of financial assets tends to use equations in which the interest rate is a denominator. And so we sort of have, with all of the free money for everyone, everyone's 401k went up, experience of, not just the last 2 years, but, before this latest, but more like the last, since Alan Greenspan, right? You're basically watching this sort of huge red ink factory, and you're seeing a nation that is basically living pretty much on debt, like a very rich person who's so rich that he can just keep borrowing. And so, that sort of experience of a nation living on debt sort of does a couple of things. It's obviously very destructive to the real economy, not that there is much of a real economy left, but it does a lot of damage to the real economy. But also from a financial perspective, it causes all assets to basically, you have to you can't just hold cash. You have to move your money around in such a way that it benefits from this beneficent force. And so it basically makes everything want to get out of cold dollars into things like, index funds. We have this interesting concept of passive investing, which is in total defiance of all economic theory. The reason you invest is that you're adding value to the market, right? Or you're lending. But passive investing is I have an index fund and it magically goes up.
And everyone can somehow make a profit off of that.
Right. And so basically, but the one thing money doesn't want to be is just plain cold dollars, because just plain cold dollars don't participate in this, except in the event of the expansion motor turns off, when the whole thing begins to rapidly collapse, as it's done a bit of this year. Okay. And then you really want to be holding cold hard cash.
Which brings us perhaps to another topic, which is a competitor money.
Yes, exactly. And so the ability to just the fact of the dollar supply inflating inflates the potential demand, assuming a sort of constant influx for this other money. And so basically what you're seeing is that the whole dollar system, when it's expanding like this, and it needs to expand because the economy is losing money, you need to generate consumer spending, you need to be printing new money by giving it to boomers in their retirement accounts, right? And so, if this system, it can't, like what you're seeing right now, for example, with the Fed raising interest rates and creating a recession. It's like basically there's sort of a game of chicken. Like, how hard can they do this before like they realize that, I mean, they see another 2008, right?
Right.
And if they see another 2008 in the presence of inflation, are they going to chicken out and just say, you know what? Actually, Putin did the inflation. We can correct the numbers. We'll add a Putin, fudge factor,
Right.
and the real inflation will be, 1% again because it's like Putin is not included, right? Or something like that. I don't know, but the like, can they get out? It's a hard problem for the Fed because they have this dictum of like affecting consumer prices. It's just a mess. The point is, this thing loses money. And to take something that structurally loses money and say, okay, you're going to run at break even is really, really hard.
Right.
So you can basically bet that this attempt to raise interest rates is going to fail and fail reasonably hard.
Okay. So
that said, I do have investment advice for right now for everyone out there. There's a current. It's the dollar. It's cash. I recommend cash.
Interesting. Even though you just went through how it's
yeah.
a leaky bucket.
But I don't think we've exactly hit that wall yet.
Okay.
Right?
Okay. Fair enough.
And so when things are contracting, basically cash is a great investment because everything is going to contract relative to cash, including Bitcoin. And this basically leads us to the sort of the point of like, what causes these crypto, winters, Uncle Yarv, and don't they suck? Yeah, they kind of suck, but they suck because they suck for people who basically deserve it. So, like, I think one thing that many people have said is it's like the sort of, you have the Bitcoin holders and the Bitcoin tourists. And, when crypto winter comes, the tourists depart. And what a tourist really is someone who's not actually saving in Bitcoin. For example, he's borrowing dollars to buy Bitcoin. Right. That is not saving in Bitcoin. That is speculating on Bitcoin. And that makes him basically a weak hand because if Bitcoin goes down, he's going to get it as margin called.
Okay. So you do not save in Bitcoin.
No, saving in Bitcoin is like basically being a naked long Bitcoin.
Mm-hmm. But a lot of people do that now, right?
Yes, a lot of people do that now, but a lot of other people will do things like, oh, I'll have Bitcoin, I'll like lend it to someone for a yield, right? So you have this have this whole sort of fake DeFi economy where just like, wow, I see a lot of lenders, but no borrowers. Like, and when you see a like financial system with like lenders and no borrowers, like you're like, oh, I see, right?
Okay.
And like it's I mean, that white powder under your nose could be salt, right? But
okay. So money is the bubble that doesn't pop. If
right.
It pops, it's a bubble, but it could also not pop, and then it could become money.
Right. It's a contingent outcome. And so there's a world in which basically, the world's stock markets sort of turn into more and more of a mess. For example, they just start like going down permanently the way Japan's did for 30 years. Like the Nikkei peaked in the 1880s. And so, you have, it could be that we hit a recession so hard and so like moribund that actually you get to the sort of Japanese level where even zero interest, you get the zero bound problem as they call it, and, which is that you basically no one wants to borrow because everything is contracting.
Okay.
And then you're like, well, we could pay people to borrow money, and like crazy shit like that starts happening. So the point is that there's a lot of the scenario under which the monetization of Bitcoin or possibly a competing currency continues is it requires savings to keep flowing in that direction. And what we see in these crypto crashes is that basically all of the weak hands not only get flushed out, but get like, they will never sit, it's like Mark Twain said, a cat that sits down on a hot stove will never sit down on a cold stove again either. Right. And these people are gone.
But also the price does appreciate over time. And
yes.
every cycle there's a few more hodlers added who seem sustainable.
Yes,
right?
yes, and the question, but of course, when you look at that, you have to say, well, is there a limit on the kind of people who would do this? Can this break out of the libertarian nutcase savings pool? There are many credible situations under which, Bitcoin does not become money after all. Of course, for example, you look at the health of the exchanges out there. That's kind of a double-edged sword. On the one hand, these are big businesses that can afford to pay protection money to Washington, which they do. On the other hand, basically, if some agency somewhere passes an order tomorrow that says banks can't talk to crypto exchanges, think about what happens. Basically, no one can sell their crypto.
Right.
There's no price. And if you have no price, you're worth zero. And you instantly go to basically the zero equilibrium.
So this is something you've been writing about for many years now, since you first started observing Bitcoin.
I'm just like, on the one hand, in a purely abstract private sector, version of the standardization problem with like perfect information. With perfect information, everybody realizes what everyone else should do tomorrow and does it today. And, it sort of happens instantaneously. Right. And so obviously we don't live in the world of perfect information, and we live in a very, very imperfect world. I was actually, when I realized sort of the game theory, I was like, wow, if I like post about this, like this could happen like tomorrow. But, we don't live in the stock market is not a super intelligence, and so you actually have this sort of long, complicated, it's essentially sort of meme warfare, right? Because the only thing that differentiates Bitcoin from JRandom Bitcoin fork, which you can start tomorrow, is basically the mimetic weight of being the standard. Right. And it's like the problem with trying to overthrow that is, let's say you have Ethereum, which is, going to have with proof of stake a lower inflation rate, a lower sort of rate of like miners creating coins that they have to sell. So, miners creating coins that they have to sell to buy electricity is a sort of natural source of sellers. If you don't have a natural, a pool of forced sellers, your levitation effect will be better. So maybe that's a case for Ethereum overtaking Bitcoin. There's a world in which that could certainly happen. On the other hand, it's like the sort of standardization, once that's happened, sort of like the standardization power of the number 2 is sort of then even weaker against like the number 3 and the number 4.
Right.
And so, and people who, I don't think there has yet been the market understands that whatever the mysterious cause of the valuation of these coins, it has something to do with being a store of value. And what they don't really understand is sort of, it's really hard to convey the sort of very simple game theory of that, which is just like, think about how much stronger the whole argument would be if Bitcoin and Ethereum were a single store of value, if they were not competing for that role. Right, because the competition makes either of them more unstable, because then you have to accept the probability that one will lose to the other, in addition to the probability that crypto as a whole will fail to dominate the world.